For those of you that don't know me, I came from the TradFi world. So I was working for a private equity fund, and I was always very passionate about economics, but I was very nihilistic about the future. I knew how central banking worked. I worked for a fund where we would buy bankrupt companies and flip them, and it's a strong business in the fiat world. It definitely wasn't something I was passionate about, and it wasn't until I actually understood what Bitcoin was that I jumped all into the industry. When I first heard about it, I was like, this is a speculative investment. It has no fundamental value. I applied my TradFi thinking that we hear very frequently today still. And it wasn't until I heard the idea that, no, this is an alternative to central banking, that light bulbs went off in my head. And I said, wow, that's a really big idea. That changes everything. And that was the first thing that got me curious about Bitcoin. It wasn't blockchain technology. It was, this is an alternative form of money. So I quit my job. I jumped all in on the industry. I wrote the book, The Seventh Property, and that was kind of designed for people who came from the world that I came from. I wrote the book that I wish I had been given when I first got involved in the industry. And because of the involvement of the Bitcoin community, it did drastically better than I ever would have guessed, and that was kind of how I got started in the industry. What I concluded from that book was that a lot needs to be built around Bitcoin. We need a financial system around this technology. And that's the difference between Bitcoin becoming just digital gold 2.0 and Bitcoin becoming the first neutral monetary system in history that's open and anybody can be involved with. That doesn't happen independently purely from the Bitcoin protocol. And today we see things like the Lightning Network and a bunch of other technologies and businesses and all of these people who are supporting ways so that Bitcoin can function as people function in a financial system today, but independently in a Bitcoin native system. So the path towards getting there is anything but clear, and it's very complex. I'm going to go through the case for how this all looks today. I built a venture capital firm so that we can invest in these types of technologies and build this system around Bitcoin. And here's kind of the case that if this works. It's fine, I can just tap it on my computer. Okay, you guys have probably seen this chart before. This is Bitcoin compared to the internet. This is Bitcoin owners, and it's outpacing the adoption of the internet. Now, this is based around an estimate. These estimates are anything but clear, but what we can really gather from a chart like this is that we're looking at a pace of adoption that's completely historic. And this is something that you can't ignore. And if we look at what Bitcoin's grown to become today, we took a lot of the different, full nodes as well as mining nodes and took estimates and geographically mapped those around the world based on certain proportions. And we say, outside of the internet itself, Bitcoin is the largest computing network in the world, distributed all over. And it's the only asset in the world with supply that doesn't respond to demand. That's also something that's very historic. So when financial professionals are thinking in terms of what am I going to invest in, they're basing it on modern portfolio theory. And there's this guy, Harry Markowitz, back in the 80s who ran a bunch of models, came up with a few ideas, and pretty much all of modern financial theory stems back from what Harry was doing back then. And the primary findings is that every investor's goal is to maximize returns for any given level of risks and the constraints that they're under. Risk can be reduced by diversifying a portfolio and more complexly having negative correlations across asset classes. And this assumes randomness in returns. All that means is spread your bets across. And a lot of modern portfolio theory is based around this idea of maximizing the amount of returns we can get for the amount of risk that we're taking on. What's the biggest risk when people perceive it in Bitcoin? This shouldn't come as a surprise. Unstable value, volatility in the price. Next to that, we have, it's not backed by the government. But far and away, we're looking at volatility being the biggest concern. And what do we see today? Historical volatility has been persistently declining over time. This is a problem that's solved as Bitcoin grows. The acceptability of Bitcoin as a form of money is another problem that gets solved as it grows. There are certain inherent qualities of the scale of the adoption of the asset that are obvious criticisms of anything when it's first starting. You could have made similar arguments against Facebook when the company was first. It's not a network effect of users yet. It's the same thing with Bitcoin. As it scales, these problems start to decline. So what we're witnessing today is something else that's historic. Bitcoin is providing superior risk-adjusted returns than any other asset class, or at least some of these primary asset classes that the average investor is looking at today. And this is what Wall Street is so excited about. This is what sparked all of it. BlackRock ran this model back in 2022, and buried in the research, they concluded that an 85% allocation to Bitcoin would have been the risk-adjusted optimal portfolio allocation. And that's what sparked all of this in BlackRock adoption. I have a tweet from this period of time calling BlackRock adoption. You guys can go dig that up. I'm proud of that tweet. And what we're witnessing now is this shift from a standard modern portfolio theory approach of a 60-40 equity debt portfolio more towards one-third, one-third, one-third approach to Troy, who was just showing these slides of what is the millennial generation looking at, recommending 30% allocation. This is proliferating in certain conversations in private wealth groups right now around the country. When I think about a wave of capital moving in, there's a lot of private banking and wealth advisors that are recommending this type of approach, more so than you'd expect. And the Bitcoin ETFs are historic. They're the best performance of an ETF ever. They hit the $10 billion AUM mark, which took gold 2 years to hit. They did it in 2 months. These numbers could even be updated a little bit more, and we know that it's one of the most profitable. It's in the top 5 most profitable products for BlackRock today. It's going to be number 1 pretty soon based on the trajectories. And we can tell that this market is absolutely massive. Here's 2 charts from my firm Epoch's annual report. And this shows that on the left we have just the top 10 companies in the S&P 500. If they swapped their cash, if they swapped 15% of their cash into Bitcoin, top 10 companies, that would be greater than the AUM of the ETFs. If we look at nation states, and we just looked at, here's the amount of gold reserves that currently exist. If they swapped 15% of the gold reserves across nation states into Bitcoin, just gold reserves, that would be more than 4 times the AUM of the ETF. So we're looking at very massive markets that Bitcoin's starting to approach today. And that's why we see negativity in the media declining. We're at this inflection point where Bitcoin is being absorbed into culture. There's a cool website, Bitcoin Obituaries, and they track all the negative mentions of Bitcoin in the media, and we can see that the observations were very significant in the 2015 to 2019 period, gradually declined over the last cycle a bit, and they're almost non-existent this cycle. It's very hard to argue against at this point. So that's kind of the primary point that I was just making with all these slides. When I was getting involved in this industry, we had to understand Bitcoin from a fundamental standpoint. Not all the data was on our side yet. Today, all of the data is on our side. This is something that's truly historic. You cannot argue against this anymore. The burden of proof is on the critics now, and that's this inflection point that we've reached. So, what does all of this have to do with Bitcoin technologies? When we get to this inflection point, right now, what we're seeing is people are realizing where the true value in all of this lies. When we compare Bitcoin to the broader cryptocurrency market, people are realizing that Bitcoin's the only asset with supply that doesn't respond to demand. In the top right, we're realizing that not only are cryptocurrency technologies pretty centralized, but they continue to centralize over time. And we're starting to see crypto use cases migrate to being used in Bitcoin. And today, there's this large void in Bitcoin ecosystem investment. So, a little bit of context before this slide. One of the points I want to make is that for Bitcoin to have this financial system built around it, there's a path that needs to be followed. And today, when you hear people getting upset about Bitcoin Treasury companies or the Bitcoin ETF, these things aren't true Bitcoin. That's absolutely true. It's not the ideal form of ownership of Bitcoin. But just like any sort of path of growth, there needs to be bridges. There needs to be scaffolding. There needs to be things that happen along the way that deal with the realities of the market that we're in today so that one day we can get to this future vision. So that bridging and that scaffolding is what we're doing with private capital around Bitcoin. We're creating mechanisms that allow Bitcoin to be adopted and grow today so that it's stronger and it's built for this digitally native, neutral, apolitical financial system of tomorrow. So when we look at this and we make the case for something like, why does it make sense economically? Well, we saw the Bitcoin adoption chart earlier, and if we look at the change in price over time, its recently adoption numbers have been outpacing pretty significantly. If we look at trading volume growth as well, those numbers have outpaced very significantly. And these are metrics that kind of show, if you're investing in a business around Bitcoin, if you think about a business that's onboarding new users like an on-ramp, or it's allowing people to trade in and out of Bitcoin or other assets, these are metrics that show what that growth looks like. If you look at a business that's giving people Bitcoin loans so that they don't have to sell their Bitcoin, growth in the lending market around Bitcoin and the collateral value of the asset, that's another metric that we can look at. If we're looking at Bitcoin being used for cross-border payments, businesses that are supplying that and the fees that they're earning based off of supporting Bitcoin and cross-border payments, that's another metric that we could look at. So we look at certain metrics and we're starting to see that we're reaching a bit more of an inflection point in growth around some of these. And none of this is perfectly clear yet today. But the way that we think about adoption as a firm is that Bitcoin adoption is going to be happening in 3 primary cycles. And since the beginning and still today, we're in this store of value phase you can see over on the left. And that's the long tail adoption. That's the hardest. That's what has to get Bitcoin had to become legitimized in people's eyes. And we view that we're really at the inflection point at the bottom of this S-curve in the store of value phase right now. Now, if we think about how Bitcoin gets adopted as an asset, what is it that's going to make Bitcoin a medium of exchange? Going back to the point about it's a benefit that comes from scale. Once Bitcoin's really fully captured the market of store of value, it's going to have significant diminishing returns at that point. And we're going to say, okay, well, you know, I'm expecting my Bitcoin to continue to go up, but I'm not expecting it to go up 70 to 100% a year on average anymore. I'm expecting 10% a year or something in that range. I'm much more likely to spend it for things that I really value in life. So that's the maturity within the store of value market happening. And at that point, when Bitcoin has captured that market, most people are going to have it. It's not going to be this weird esoteric thing that you have to sell to your family at Thanksgiving and argue over. It's going to be something that most people don't understand and most people own because that's what their parents did, that's what their friends did. And that's when we're at this point of maturity within the market where in the same way people think it's good to, you know, buy some stocks or buy real estate, they're going to think it's good to just save in Bitcoin. So we reach this point of maturity within that adoption, and then that's when people say, well, we all have Bitcoin, and I would prefer to accept Bitcoin as opposed to any other alternative for money. Pay me in Bitcoin. It's not driven by people saying, I want to give up my asset that's going to appreciate 10% a year. It's give me that asset, otherwise I'm not giving you what you want. And that's how this is going to start happening over time. So we get into this medium exchange phase, and then ultimately people start denominating transactions in Bitcoin, and that's when we're kind of in the unit of account phase. So as a capital provider, when we look at businesses that are needed and relevant, we think, well, Bitcoin's being used as a store of value today. What's relevant to that? On-ramps into Bitcoin, exchanges for Bitcoin, custodial providers, multi-sig, all these different technologies that allow people to buy, sell, hold Bitcoin. Now, you probably heard of this analogy, you know, the Bitcoin system is going to be built in layers, and while there's certainly truth to that, it's an incomplete view of how we view the Bitcoin ecosystem as a whole. We view it more as a tree, where Bitcoin is the trunk, and there's branches that are stemming off of it. And these are the different companies, these are different protocols, different technologies that are all trying to find sunlight. They're trying to find users, they're trying to find adoption, use cases, and then they ultimately grow the trunk through that process. And you can see inside, over to the left, we have within the rings of the trunk, that's kind of where the layers are. And we can see there's these different protocols that enable all these branches around it to work better. So as Bitcoin grows and as the protocols around it grow, these branches are creating all of that growth within it. So the number one question when we're doing this type of investment that we need to justify for people is, well, why wouldn't you just invest in Bitcoin? And the first thing that we always say is what we're doing is not even comparable to Bitcoin. Bitcoin is financial insurance that you cannot get through any other asset. you should always have Bitcoin before you even consider something like what we're doing. That being said, there's several reasons why investing in businesses that are related to Bitcoin over the medium to long term could be very successful. First, the simple analogy is that branches grow faster than trunks. And if you can imagine that businesses today that are startups being valued at $5 million, becoming billion-dollar businesses in the future financial system of Bitcoin, that's going to be very high return potential. To expect that within the next 5 to 10 years, Bitcoin's going to grow 300x over that period, certainly possible. But we are starting to witness more diminishing returns. It's hard to say from a timing standpoint what's going to work out. There are going to be branches that grow and potentially die. Bitcoin will be outliving a lot of those branches. But nonetheless, they're going to have very rapid growth and strong returns. So there's that perspective that is a differentiator. There's also different exposure to risk characteristics within these businesses. You can have a business that even if Bitcoin has a 70% drawdown, is still going to be doing fine and actually making a profit during those types of periods. You could think during a market crash how an exchange is actually capturing a lot of fees from trading during that. So there's counter-cyclical aspects to it. But pulling away from some of the more technical details, the number one thing is that within this industry, it's important that as you grow the infrastructure around Bitcoin, that increases the potential market size of Bitcoin. So that's one of the primary things I would say to anybody who's a long-term hodler is that supporting Bitcoin companies, whether that's through us or doing that directly with companies that you know, that's something that ultimately benefits the Bitcoin you own as well. This is a reflexive relationship that we have, where as you have more branches, that's going to be growing the trunk over time. And far and away, with the opportunities we're looking at, this vision for a future of a digitally native financial system, nobody knows exactly what's going to happen. And what really matters is that we're never going to have perfect clarity on these things. What matters is that this is the right thing to do. It's something that Bitcoin needs, and it's something where we can definitely witness significant value accruing over time. So by the time you do get that perfect clarity, that opportunity is already going to be gone. So the way that we view this building out is similar to how the internet was built in layers, and similar to how our financial system was built in layers. Bitcoin's also going to be having this layered architecture built around it. And this is kind of a little bit of a graphic that shows, in the middle, we've got this layered architecture analogy people talk about, and around it we have more of the ecosystem. But we view Bitcoin as this base layer protocol. That's very similar to like a Fedwire. If you look at the base layer on this prior side, you can see Fedwire over here down at the bottom on the right side. And on top of that, you have Swift, ACH, Visa. You have middleware like Stripe, Square, Braintree, and then ultimately the application layer that everybody's using. If we go back to this Bitcoin layer, it's going to be a very similar thing. We're kind of at this point where we have this base layer protocol, and then we have these other protocols that allow Bitcoin to be moved more quickly, and we allow people to do more things with it. And that's like Lightning Network, state channels, state chains, side chains, mints, rollups, all these different things that are plugging into Bitcoin and creating ways to use it differently. And then there's a middleware layer that allows all of those forms of infrastructure to speak with one another. And on top of that, we have an application layer, and that's what more like consumer technology is going to be using in the future. We're not there yet. There's definitely a lot of that exists, but we're a long ways away in terms of a lot more infrastructure needs to get built out, adopted, and integrated before a lot of that's going to proliferate. And then integrated within this stack, we have on the left side, peer-to-peer network applications. This is something like Nostr that can be integrated with Bitcoin. And on the right side, we just have general banking software and service providers. This is what's going to be happening with banks adopting Bitcoin now that the regulatory environment's changed significantly. Below all this, we have infrastructure providers, people building the actual hardware that's needed, such as miners and hardware manufacturers of mining machines, or a company like Cold Card. All of these different providers are underpinning all of it with hardware. Here's a massive, ugly table from our annual report that I wanted to put in here just to show you. There's a lot. This is not even close to all of it, but we put in some examples of, here's a bunch of different categories of businesses that exist today within the ecosystem. It's going to be a lot bigger this next year. My firm puts out an annual report on the Bitcoin ecosystem every year, and we're just going to keep adding to it. But we have categories like, the native applications and platforms. This is the stuff that's digitally built within Bitcoin. It's not integrating into other systems people are using. Because it's not integrated, it's a lot harder to get users today. But this system is building out in parallel alongside other businesses that are integrating it into what people are using today, meeting the consumer where they are. And that's like consumer financial services. And then we have the institutional financial services. I don't know, can you guys read this from back there? No, okay, whatever. So it's a lot of companies and it's a big map. And we have a lot of different financial service providers and to the points I made earlier around physical infrastructure. So I want to go through, how am I doing on time? Oh, nice. You're going perfect. So there's kind of two primary trends. There's a lot of different things I can talk about. We look at a lot of different companies. But there's two trends I figured that make sense today. My firm is coming out with a big report that some of these topics are going to be in within the next 2 weeks. That's covering, everybody's talking about stablecoins and what's going to happen with bank adoption related to that. And we put out a report to say, here's what's going to happen with Bitcoin related to all of that. And there's two trends that we think are pretty top of mind for people. So Bitcoin treasury companies. People just won't shut up about them. And we put together a little bit of a thesis around how we think this is going to play out. So who here is familiar with a yield curve? We've all heard of a yield curve for the most part. All it is the complex word for it is the term structure of interest rates. And it's just, it's a curve that shows the relationship between the maturity of government debt and the yield that it's ultimately paying, the interest at the current market price. And that yield curve is used to kind of express, here is the structure of relationships. There's actually, hello, oh, there we go. And there's actually debate. There's a lot of people that'll, I'm gonna get too off track talking about yield curves, but okay, so there's debate around how to interpret a yield curve. I'll leave it at that. But what's really interesting is Nick Bhatia kind of came up with this idea when we had the Lightning Network emerge of, well, what do we do with our Bitcoin if we want to earn some sort of rate of return on it other than just put it in cold storage? And there's a spectrum of risk that we can take on doing that. And there's kind of this digitally native yield curve that's emerging on Bitcoin. So in the bottom left, which is probably hard to see, we have something that says cold storage. And that's your lowest risk ownership of Bitcoin. You're not trying to earn any sort of rate of return on it. It is still a form of risk. You can lose your cold storage. And nothing is riskless in this world. But the next step up is you could commit it to the Lightning Network and earn fees for network routing. It's like a very, very low risk form of earning interest on Bitcoin. And that's kind of akin to the risk-free rate that we see in traditional markets today of government debt. It's akin to how people would think about that. Of course, that word doesn't make any sense, but we have this structure of different things that you can do beyond that. So if you're like, okay, I just don't want to commit capital to allow people to route across the Lightning Network, I want to provision my liquidity into a form of leasing because somebody needs to balance their Lightning channel, and I have liquidity that I can give them to do that. So you can lease that liquidity directly over that network. This also applies to state chains like Spark, if you guys have heard of the company LightSpark. And then now Lightning is coming out with a way to create stable coins on it, and those are probably going to be lent to people. So you can have forms of asset lending, and this is all being used natively within Bitcoin for something like a stable coin. And all these infrastructure layers that are being built on top of it, some of these might have a proof of stake consensus mechanism that you're putting it into. And in a way to think about this is it's just a mechanism that allows people to have ownership over the Bitcoin when you put it into another protocol in the same way if you were to send your Bitcoin to an exchange, but the key ownership is more distributed. So it's a consensus mechanism related to that. Some people will choose to stake their Bitcoin within these things and plenty won't. But that's also a form of risk that you can assume and earn a rate of return from doing so. That's kind of all on this digitally native side of the yield curve. And then To the right, we have the more traditional side of the yield curve, where similar forms of liquidity provisioning, where if you have an exchange, for example, we have Abhi, who runs a cross-border payment company, Krobo, and they're allowing people to send remittance payments from the US to India. And they use liquidity providers that help them, and they have to pay a fee for those liquidity providers. So if you have Bitcoin, you can be a liquidity provider. And then people can just simply lend directly and assume the risk of lending, as people have throughout time. So there's all these different forms of risk, and we have this native yield curve building out. And Bitcoin treasury companies are people with a lot of Bitcoin. And we're viewing this as the Bitcoin treasury company is something that's going to need to find a way to differentiate over time. There's going to be a lot of people where if your entire business model is owning Bitcoin and you don't have another model, then you're either going to need to find really efficient capital provisioning. You're going to need to find a way to earn a rate of return on your Bitcoin so that you're differentiated from some of your other competitors and you earn that Bitcoin yield that Michael Saylor is always talking about. Or you need to have an operating model that is very synergistic with having Bitcoin. So any sort of Bitcoin business that needs liquidity provisioning, that's very synergistic with the Bitcoin treasury company. So what we're viewing is, we kind of view the Bitcoin treasury companies as people that are going to buy our bags. They're going to buy all the companies that we own. And that's one way they'll differentiate, as well as having like treasury management type companies. So that's one of the big ideas, is that we're going to have a bunch of Bitcoin companies, and I think that this is something that could probably create like a systemic risk within the industry over time. Allocating Bitcoin across this entire curve is going to be really hard. And to do it well and do it with scaled capital is going to have economies of scale associated with it. So when people are doing that, we're probably going to end up seeing a lot of the Bitcoin treasury companies give their Bitcoin to other treasury companies that are much better at doing this than them. And they're going to effectively turn into like a new version of some of the BlockFis that emerged last cycle. So that's one of the things that we see emerging, is some treasury management companies over the next year or two. And there's going to be a lot of risk and concentrated pools of Bitcoin within those areas. It's not as much that a bunch of Bitcoin treasury companies might go bankrupt, and that'll certainly be true, but they're probably going to be scaling their liquidity into concentrated pockets amongst one another. Another interesting trend is Bitcoin bank adoption. So with the Trump administration entering the White House, they changed the regulatory environment for the industry. And this has large downstream implications for Bitcoin. But they repealed this ruling, SAB 121, and long story short, that rule was prohibitive for people, or for banks ultimately adopting Bitcoin. It meant that they had to hold the digital asset as a liability on their balance sheet. They couldn't hold custody of an asset as an off-balance sheet liability. Therefore, what happens is they have to meet these certain standards of risk and solvency from regulators, and if they were to put digital assets in a significant way on their balance sheet from doing it, they would no longer meet those standards. So it was a non-starter. Trump entered office, removed that rule, it was repealed, and now, okay, cool, we can support digital assets and we can hold the liabilities off balance sheet like we do with everything else that's a deposit. So that kind of changes the game, and earlier this year we're like, okay, this is going to be a very significant trend. How is this going to be impacting Bitcoin? We see how people are going to be talking about stable coins, and that's going to be something that I'll get to in a minute, and it's very relevant to Bitcoin. But that was one of our curiosities. So we teamed up with the CTO of Silvergate Bank, who is providing the primary form of settlement across all exchanges within the crypto industry. And they ultimately, because of Operation Choke Point, who knows Operation Choke Point 2.0? How familiar? We're pretty familiar? Okay, cool. So Choke Point, like that bank was completely solvent. It was a very successful business. They liquidated with an equity surplus, and it was just 70% of our revenue comes from this industry, and you're cutting us off from it, so we should wind this whole operation down. It was a terrible thing. And nonetheless, we teamed up with their former CTO, and we're like, let's write a report and let's talk about how Bitcoin is going to be impacted by bank adoption. For anybody who's read some of my writing beyond just my book, I'm not somebody who is super against the idea of banking. I think it's a necessary evil for adoption, and I can spend some time after in the Q&A and go through some of that. But have an open mind when I'm talking through this, and I'll kind of walk you through how I think Bitcoin is going to ultimately get into the banking system. If we look at this graphic over here on the bottom left, oh, I got to go quick. Over here on the bottom left, this is a graphic that shows at a very high level how the financial system is structured. It's called a two-tier model. One is central bank, that's tier one. Tier two, commercial bank. There's some commercial banks that have an account at the central bank. They're allowed to plug into it. And there's some that don't. And if you don't have an account at the central bank, you have to go through one of the commercial banks that does. So that's called a correspondent bank. And we can kind of see over to the left side of this box, it says payment system. We have a correspondent bank that's integrating into the Bank of England over here. So if you're a US bank and you need to be interacting with the pound, then you have to go through an English-based correspondent bank to have that sort of interaction. You don't have a direct account. There are some that do, but the goal would be to have master accounts at every central bank to function most efficiently within this type of a system. What we view, the banks are going to be viewing Bitcoin as an alternative central bank. It's going to be highly differentiated. It's going to be the only neutral central bank. So we put Bitcoin in this graphic up here in the tier one for central banks. And what we're going to see is a Bitcoin correspondent bank model start to emerge around that. And what is that? That's Bitcoin native providers like Lightning service providers and a lot of these financial companies. They're going to be a banking license away effectively from being a correspondent bank within this type of a system. We're also going to have digitally native companies which are doing this today. So that's like, CeFi companies that are doing this today, like a Coinbase and Erebor, Peter Thiel's new venture that they're working on. And Anchorage is another major custodian. A lot of them are supporting all of this bank adoption, but we're going to see more Bitcoin companies doing this as well. And then in front of all of that system, we'll have the fintechs. Like the fintechs just layer on top of all of that. So kind of with that context, what we're witnessing now, if we look at this graphic over here in the top right, what stablecoins are doing is they're cutting out the central banks and the commercial banks. They're just saying, we're going to go straight to the debt. Because in the first system, debt goes to central bank goes money into reserves into commercial bank creates money and gives it to people. Now it's just debt goes into the fintech all the way at the bottom. So that's disintermediating the financial system. And if you look, when the Genius Act was getting passed, there were letters written by organizations within the banking community saying, if you don't prevent stablecoins from being able to pay deposit interest, if you allow stablecoins to be directly in competition with banks, it's going to obstruct the banking system. We can't compete with this. And so that's what we witnessed in Genius. Stablecoins are only allowed to use government debt and reserves now, and they aren't allowed to pay interest. But what we are going to see is the tokenized deposit. That's going to be the new term that banks are using to create a stablecoin that pays interest, and only banks are going to be allowed to issue those. So that's going to be one of the major trends, and then keep your eyes open for the issuance of a tokenized reserve deposit. That's going to be the new word used for like a wholesale CBDC. And that's going to be very akin to the CBDCs that most people are very against and nobody wants. So with all of that, one of our theses is that yield, in quotes, will find a way. And we're going to start watching Bitcoin infect the reserves market of all of this. So despite the Genius Act creating regulatory ring fencing that's going to prevent stablecoins from being able to put Bitcoin in their reserves, we look at how Tether holds their reserves today, and we see that 5% of their reserves are in Bitcoin. And as stablecoins start to proliferate throughout the world, we're going to see competition. So when people talk about the game theory for Bitcoin adoption globally, we say, well, if the US doesn't adopt it, then other countries will, and then they're going to have to compete against those other countries that are doing it. We're going to witness the same thing happen with stablecoins, where we're going to have these lack of fungibility between US-based ones and then international ones that are paying interest. What stablecoin is going to pay the most interest? The one that has the best collateral backing with the highest returns. What's going to give it that? Bitcoin. So what are we going to see? We're going to watch Bitcoin take over the stablecoin market as a reserve over time. And what's going to happen is that one day, when Bitcoins hit that maturity within the store value phase, people are going to say, why the hell am I trading a stablecoin? Why am I not just trading the reserves that are backing this thing, that are paying the interest in the first place? So that's what we're looking for. Ultimately, we're going to have a digitally native system of banks without bankers, but first we have to infect the reserve market of the banking system. And this banks without banker system, we're always looking at technologies like this today as well. The adoption for much of this, because it requires so much scaffolding, is going to be a long tail. We're ready for it, we're here to support it, and that's kind of our job. I'll leave you guys today with changes coming around all of this. There's this guy, Eric Hoffer, who was a social philosopher, and he spent his career just studying revolutionary movements. And if you read his book, The True Believer, it's pretty uncanny with what's happening with Bitcoin and a lot of the parallels in revolutionary movements. And he says, in a time of drastic change, it is the learners who inherit the future. The learned usually find themselves equipped to live in a world that no longer exists. So keep learning. I am underwater on learning about new things within Bitcoin. There's a whole system building around it. And don't just stop at learning how to put it in cold storage. Figure out everything else that's happening to allow you to adopt it. Thank you. I can do a Q&A.
It sounds like you're saying that we might want to pick up some Bitcoin in case it catches on.
This is true.
Okay,
Yeah,
I was just making sure. I just wanted a quick summary.
In the nature of keep learning, you mentioned state chains and channels. Explain it. I don't know it.
Oh, I'm one of the worst people to be able to explain this. A state channel is like the Lightning Network. You can create agreements with people. You can enter into effectively a contract. Think of it kind of like an escrow agreement that automatically executes one way or another for somebody. And you can agree that we're going to have collateral, and that's going to be Bitcoin within this channel between both of us. And I can pay you. And we're just going to have, think of it like promises that happen back and forth. And then that's going to be changing where the collateral goes once we exit that escrow agreement between one another. And that's what's happening within a channel on the Lightning Network, is they're instantaneous payments, because as long as you have enough collateral in the system to back those promises you make between each other, we know that once you close that channel, it'll say, okay, you just promised $100 worth of Bitcoin in payments to him. Now we're going to take $100 worth of Bitcoin payments of that collateral when we exit the system. So like that's kind of what's happening within a channel. Within a chain, they're kind of plugging those channels into a blockchain, which is a lot more complex. Companies like LightSpark are building that out, and they're much more trusted than doing it peer-to-peer in the Lightning Network. But it also creates a user experience that institutions are capable of using today. So that's why David Marcus has been pushing so heavily on adoption of something like LightSpark for banks and other financial providers. And he's basically just trying to circumvent a lot of bank technology with some of it.
Hey, thanks, Eric. You mentioned something about the Genius Act. I haven't been paying attention. I'm sure others in the room haven't either, but the ring fencing around stable coins where they won't be able to hold Bitcoin, is that what you said?
Yeah, it's like short duration government maturities is what they're going to be holding. Okay,
but despite that, you expect stable coins to drive or to hold Bitcoin, basically. How's that going to work?
This is a more long-term view, right? But like stable coins hold, like Tether, the largest far and away. It is the market. Has been holding Bitcoin in reserves for a long period of time, right? So now the U.S. is going to put in these laws, and it's going to be like, okay, so you get U.S. Tether, and that's going to be the shitty version of Tether. And then you're going to have the international good version of Tether, and people are going to, it's a big world out there, right? And people are going to be adopting all of that globally. So we're going to have a globally competitive environment around some of this in the reserve market. And I think that competition, laws change all the time. That could change things very quickly. Or what it could mean is that tokenized reserve deposits, the bank ones, maybe those start trying to compete against the stable coins internationally, because those are going to be the domestic interest-paying forms of stable coins. And then maybe Bitcoin starts getting into those reserves over time.
Gotcha.
But as long as Bitcoin is a better money, it's going to infect the reserve market over time.
Thanks, Eric. The way that the Genius Act is kind of ring fencing that, when you look at something that Saylor's doing with the preferred products, Stretch now seems to be an alternate to, a savings account. Is there something that's like tokenizing securities where, say, Taproot Asset Protocol or something like that, you could use your stretch, say, as money once it's tokenized?
Thank you for asking this. I was supposed to have talked about this and I left it out in my head. Yes, so in this report coming out, we've used this as our primary example of the stretch economic model, and what Saylor's doing is that's the economic model that's going to be emerging behind these tokens. So like whether it's through Taproot assets, whether it's through anything, that economic model makes sense. The problem is it's on brokerage account rails right now, so I can't go trade my brokerage account stretch with people. But once, to your point, it's on the right rails, that's the economic model of Bitcoin reserve yield that we're going to see, that everybody's going to have to be competing against. So yeah, it's precisely what Saylor is doing right now. It makes a ton of sense. It just needs to exist on the right rails.
Let's say you were talking to a 401k plan's financial committee, and you were advocating for the Bitcoin ETF to be added to the plan as an option. What data or like ratios would you use to convince the committee to make it into the plan?
This one. I would use that chart as the first. I mean, this whole presentation is what I do to make those types of TradFi guys reconsider Bitcoin. This is all the data. That everything happening within Bitcoin is completely historic. Whenever I walk into a room with those types of people, I don't try to argue and convince them of what is money. That takes too long. And they're so hardwired to one form of thinking that that's not really how you do it. The best way to do it is to just say, we're talking about the best performing asset, measurable history. It's the largest computing network in the world outside of the internet itself. It's the best performing financial product in Wall Street history. It's providing the best risk-adjusted returns beyond any other asset class. The fact that you don't understand this means you're breaching your fiduciary duty, and you need to figure that out quickly because you're totally getting out-competed by what's happening. And that'll put people on their back heels.